Hello, traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we are going to be talking about the EMA Swing Trading Strategy, which is a simple yet effective way to identify trends and time your entries with precision. So, by the end of this video, you understand how to use EMAs to spot opportunities and manage risk. Without wasting any much of your time, let's get started. So the EMA swing strategy is built around the exponential moving average, which is the EMA, a technical indicator that highlights trends by giving more weight to recent price data. Swing trading focuses on capturing price movements over a few days to weeks. The EMA serves as a baseline for these swings, allowing you to spot entry and exit points efficiently. For example, when the price moves above the EMA, it signals an uptrend, offering opportunities to buy. And when it moves below the EMA, it signals a downtrend, suggesting shorting opportunities. You can see the price moving above the EMA here, signaling buying opportunities to long this market. And at the same time, you can see here across the price moving below the EMA, signaling opportunities to sell or short the market. So to make this strategy actionable, traders often use specific EMA periods, such as the 20 EMA for short-term trends or the 50 period EMA for medium-term trends. Just like you can see the 20 and the 50. And this helps make up the swing trading strategy which we are talking about. These EMAs they can act as filters for market noise, and they can help you focus on clear signals. Additionally, combining multiple EMAs like a 20 and 50 crossover can enhance trend detection and provide confirmation for your trades. The key advantage of using EMAs in swing trading is their ability to adapt quickly to market conditions, unlike the SMA. This allows you to enter trades during pullbacks or retracements while staying aligned with the overall trend direction. So let's talk about the strategy, the step-by-step EMA swing trading strategy. Now, the very first step to use this EMA swing trading strategy is to set up your charts just like this. Set it up with a short-term EMA like the 20 period and the longer-term EMA like the 50 period. This short-term EMA reacts faster to price changes. The blue line here is the short-term EMA, while the red line is the longer-term EMA, and the red line is the 50 period EMA, while the blue line is the 20 period EMA, as you can see in the settings. And after this first step, the next step is to identify the trend. When price stays above both EMAs, it indicates an uptrend and you should look for buying opportunities. Also, when it stays below, it indicates a downtrend. As you can see here, we have at the start of October here, sorry, at the end of September, we had price moving below both EMAs and staying there. We have several pullbacks, and this just gave us opportunities to sell or short the market. If you're looking to enter a sell trade as a result of this uh price showing us this bearish trend starting, you could look to enter using price action. You could use key levels, or you could also use candlestick patterns like the bearish engulfing, pin bars, and evening star, shooting star, and all those candlestick patterns. Here, where price reacted to this moving average using it as dynamic resistance, you can see this bearish engulfing candlestick pattern there, and you can see the shooting star candlestick pattern here. There are just multiple areas and indications you can use to place your sell entries, stop loss above the high, and your take profit at fixed risk reward ratios of 1:2 or 1:3, or you could just target uh previous support levels like this one. That is one way to use it. Wait for price to go below the moving averages, and once it's below it, wait for pullbacks and look for opportunities. It could be through price action. As you can see here, this was previously a support level that got broken, and here we have a new resistance level which we can sell off from. as you can see, and take profits all the way down. So just look for price action, look for candlestick patterns and indications which you can use to sell once price is below the both moving averages. Now this is for a short trade example. Let's look out for a buy trade example. You have the price moving above both EMAs here, signaling a bullish trend. And now this is the point where you wait for confirmations before you enter your buy trade. You have price giving us the pullback into the moving average, using it as a dynamic support level for continuation to the upside. So if you wanted to find a way to enter, use price action strategies here, which is you can see this former support levels, former resistance levels like this one, and you could use that breaker block to place your buy entries from here, stop losses below here, and take profits all the way to this level here. Now this is just one way you can use. You can also see that if you insert your Fibonacci retracement levels, you can see price reacting off of the 50%, which is a major key level using the Fibonacci. You also enter a buy, stop losses below, this is the 1.8% level, take profits all the way. So that's the main thing, is to ensure that price remains above both moving averages, no matter what. As that when that happens, it signals that we are bullish and we can look for buying opportunities in the market. Now, managing your exits and managing your trades is just as important as your entries. Use dynamic levels like support and resistance zones or trailing stop loss to lock in gains while allowing uh, the trade to run all the way to your take profit, or allowing the trend to continue. For instance, in an uptrend, you could place your stop loss just below the most recent swing low. This way, if price reverses unexpectedly, your risk is limited. If you were to enter a buy trade from this retracement back into this dynamic support, just place a buy with your stop loss being below this swing low right here. Take profits all the way, and that's how you can use to manage your trades instead of putting up tight stop losses, because you may get stopped out if the market decides to move against you. So right traders, you've come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.